Every generation thinks it understands money. We swipe, tap, and trade it daily, confident it will hold value tomorrow. But every time humanity changes how it uses money, the balance of power shifts. And make no mistake, that shift is happening again right now. Cash, coins, code, three forms of money locked in a silent war over control, privacy, and survival. History tells us this battle isn't about technology, it's about who gets to decide what money means and who gets left out when the rules change. Long before digital wallets or credit cards, money began as a promise, a way for one person to trust another without knowing them. In ancient Mesopotamia, around 3000 BCE, clay tablets recorded debts between merchants. A farmer could deliver grain today and receive payment in silver months later, not because they trusted the person, but because they trusted the system. The temple priests kept the records. The king's seal guaranteed enforcement. This was the first great innovation of money. You didn't need to know someone personally to do business with them. You just needed to trust the authority backing the agreement. Then came coins. Around 600 BCE in the Kingdom of Lydia, in what is now Turkey, rulers stamped metal discs with official seals. These coins had intrinsic value, they were made of gold or silver, but the stamp meant something more. It was a guarantee from the king that this coin contained what it claimed to contain. No need to weigh it, test it, or question it. The authority of the state stood behind every transaction. Coins spread like wildfire across the ancient world because they solved a fundamental problem. How do you trade with strangers? How do you move value across distances without dragging sacks of grain or livestock? Coins were portable, divisible, and most importantly, trustworthy, or at least they were supposed to be. But here's the catch that every empire learned the hard way. When the state controls the money, the state can manipulate it. Rome knew this. For centuries, the Roman denarius was the gold standard of the Mediterranean world. Merchants in Britain, Egypt, and Persia all accepted it. But when emperors faced military expenses they couldn't afford, they discovered a trick. Reduce the silver content of the coin, keep the face value the same, but quietly mix in cheaper metals. At first, nobody noticed. A coin that once contained 95% silver might drop to 90%, then 80%, then 50%. By the 3rd century, the denarius was little more than a bronze disc with a silver wash. Inflation exploded, prices skyrocketed. Wages couldn't keep up, and the empire that had ruled for centuries began its long, slow collapse into chaos. The lesson was clear, but it was also ignored, because every government that followed made the same mistake. They couldn't resist the temptation. Coin centralized value in rulers, paper centralized it in banks, and digital centralizes it in algorithms, and that's where the world stands, divided today. For centuries after Rome, physical money remained king. Whether in the gold dinars of the Islamic caliphates, the silver taels of China, or the doubloons of Spain, cash gave ordinary people a measure of autonomy. It was tangible. You could hold it, hide it, and spend it without anyone's permission. Governments could print it, mint it, or debase it, but they couldn't watch every transaction. That privacy was power. A merchant in Renaissance Venice could conduct business without the Doge knowing every detail. A farmer in colonial America could save coins under the floorboards without the crown tracking his wealth. Cash was freedom in your pocket. And in the digital age, that freedom is vanishing. The transformation began quietly. In the 1950s and 60s, credit cards emerged as a convenience. Why carry cash when you could charge purchases and pay later? Banks loved it because every transaction generated a fee. Governments tolerated it because they could tax the interest. And consumers embraced it because it was easy. Then came ATMs in the 1970s, allowing people to access their money anytime, anywhere. No need to visit a teller. No need for banking hours. Money became numbers on a screen, accessible at the push of a button. By the 1990s, the internet accelerated everything. Online banking meant you could move money across the world in seconds. PayPal, launched in 1998, allowed strangers to exchange value digitally without ever meeting. E-commerce exploded. Physical stores began to feel archaic. Why walk to a shop when you could click a button and have goods delivered to your door? Money was no longer something you held. It was something you moved, tracked, and managed through interfaces designed by corporations and regulated by governments. At first, this looked like pure progress. Convenience replaced hassle, speed replaced waiting, efficiency replaced friction. But with that transformation came something darker: control. When money exists as data, it can be monitored, manipulated, and weaponized in ways physical cash never could. Banks could freeze accounts with a click. Governments could seize funds without setting foot in your home. Algorithms could analyze your spending, predict your behavior, and flag you as a risk before you ever committed a crime. Credit scores became digital scarlet letters determining who could buy a home, start a business, or even rent an apartment. The line between financial management and surveillance blurred until it disappeared entirely. In China, this reached its logical extreme with the social credit system. Your financial behavior, your social media activity, even your friendships could raise or lower your score. A low score meant restricted access to loans, travel, and education. The state didn't need to arrest dissidents when it could simply cut off their ability to function economically. Money became not just a medium of exchange, but a tool of social engineering. And while the West criticized China's system, Western governments and corporations were building their own versions just with better marketing. Every stimulus payment, every tax return, every welfare check now flows through digital channels that track who receives what and when. Banks file suspicious activity reports for transactions over certain thresholds. Governments share financial data across borders. And tech companies, the real power brokers of the digital age, sit in the middle of it all, collecting fees and data with every transaction. The modern citizen isn't just a participant in the economy. They're a data point in a surveillance system so vast that even George Orwell would have struggled to imagine it. Then came the counterstrike. In 2009, in the aftermath of the worst financial crisis since the Great Depression, a pseudonymous figure, or perhaps a group, calling themselves Satoshi Nakamoto, published a white paper titled Bitcoin, a Peer-to-Peer Electronic Cash System. The timing wasn't coincidental. Banks had gambled recklessly, crashed the global economy, and been bailed out with taxpayer money while ordinary people lost their homes and savings. Trust in institutions was at an all-time low. And into that void stepped an idea so radical it seemed almost naive. Money that existed without banks, without governments, without any central authority at all. Bitcoin's promise was elegant. Instead of trusting institutions, trust mathematics. Instead of central ledgers controlled by banks, use a distributed ledger maintained by thousands of computers around the world. Every transaction would be recorded on a blockchain, a chain of cryptographically secured blocks that anyone could verify but no one could alter. No single entity could shut it down, censor it, or manipulate it. It was designed to be incorruptible, transparent, and free from the debasement that had plagued every currency in history. The early adopters were a mix of libertarians, tech enthusiasts, and financial outcasts, people who had been failed by the traditional system or simply didn't trust it. They mined Bitcoin on home computers, traded it in online forums, and treated it like a digital gold rush. For years, the mainstream dismissed it as a curiosity, a toy for computer nerds and criminals. After all, what gave Bitcoin value if no government backed it? The answer, its proponents argued, was the same thing that gave gold value for thousands of years: scarcity and trust. Bitcoin was programmed to have a maximum supply of 21 million coins. No government could print more, no central bank could inflate it away. It was in theory the hardest money ever created. But revolutions come with contradictions. Crypto promised freedom, but it delivered volatility. Bitcoin's price swung wildly from pennies to thousands of dollars and back again, sometimes within weeks. It promised anonymity, but every transaction was recorded forever on a public ledger. Law enforcement agencies learned to trace Bitcoin flows, and exchanges were forced to implement Know Your Customer regulations, turning crypto into just another monitored system. It promised equality, but early adopters and miners accumulated vast fortunes, creating new digital oligarchies as concentrated as any Wall Street firm. And it promised decentralization, but mining power consolidated in massive operations, often in countries with cheap electricity and authoritarian governments. Still, Bitcoin planted a seed. It proved that money didn't have to be issued by a state. It didn't need gold vaults or central banks. It could exist as pure information secured by cryptography and consensus. Thousands of alternative cryptocurrencies followed, each claiming to improve on Bitcoin's flaws. Ethereum introduced smart contracts, programmable agreements that could execute automatically without intermediaries. Stablecoins pegged their value to dollars, offering the stability of fiat with the speed of crypto. Decentralized finance platforms promised to recreate banking without banks, lending, borrowing, and trading without middlemen taking their cut. For a moment, it seemed like the future of money might actually be decentralized, that ordinary people might reclaim control from institutions. But governments don't surrender power easily, and they certainly don't surrender control of money without a fight. The response came in the form of CBDCs, central bank digital currencies. These aren't Bitcoin, they're not decentralized, permissionless, or anonymous. They're the exact opposite. CBDCs are digital versions of national currencies issued and controlled entirely by central banks. China launched its digital yuan in pilot programs as early as 2020. The European Central Bank began exploring a digital euro. The Federal Reserve started researching a digital dollar. And the message was clear: if money is going digital, governments intend to control it. On the surface, CBDCs look like an upgrade. Instant payments, lower transaction costs, financial inclusion for the unbanked. Central banks promise that digital currencies will make the financial system faster, safer, and more efficient. But scratch beneath the marketing, and you find something far more concerning: programmability. Unlike cash, which is dumb, you hand it over and the transaction is final. Digital currency can carry instructions. It can be programmed to expire if not spent by a certain date, encouraging consumption during economic slowdowns. It can be programmed to restrict certain purchases, blocking transactions the government deems undesirable. It can be programmed to automatically deduct taxes the moment you earn income, eliminating evasion but also eliminating financial privacy. Imagine receiving a stimulus payment that you must spend within 30 days or it disappears. Imagine your paycheck being taxed in real time, with rates adjusted daily based on policy changes. Imagine trying to donate to a political cause only to have the transaction blocked, because the government considers that organization problematic. This isn't dystopian speculation, it's the logical conclusion of programmable money combined with centralized control, and it's already being tested. In China, the digital yuan allows the government to track every transaction in real time. Citizens can be rewarded with discounts for approved purchases or penalized with fees for unapproved ones. The system integrates seamlessly with the social credit score, creating a financial panopticon where privacy is a relic of the past. When COVID lockdowns hit, Chinese authorities could see exactly who was spending money where, allowing them to enforce quarantines with precision. The same technology that promised convenience delivered total surveillance. Western governments insist their CBDCs will be different, that privacy protections will be built in, that democratic oversight will prevent abuse. But history teaches us that once a tool of control exists, it will be used. The Patriot Act was supposed to be temporary, passed in the panic after 9/11 to fight terrorism. 2 decades later, it's still law, and its surveillance powers have expanded far beyond their original scope. The same pattern will repeat with digital currency. The infrastructure will be sold as safe and efficient. The controls will be introduced gradually, first for criminals, then for tax evaders, then for anyone the state deems a threat. And by the time people realize what they've lost, opting out will be nearly impossible. Because here's the other side of the equation. As digital money rises, physical cash is being systematically eliminated. In Sweden, more than 80% of transactions are now cashless. Some businesses refuse to accept cash at all. Elderly citizens in rural communities, those least equipped to navigate digital systems, find themselves financially excluded. In India, the government attempted to demonetize large currency notes overnight, forcing millions to deposit their cash in banks where it could be tracked and taxed. The official reason was fighting corruption. The real result was increased government control over the economy and significant hardship for the poor. Even in the United States, cash transactions are increasingly stigmatized. Paying in large bills raises suspicion. Banks file reports on cash deposits over $10,000. Civil asset forfeiture laws allow police to seize cash without even charging someone with a crime, under the assumption that large amounts of cash must be tied to illegal activity. The message is clear: if you have nothing to hide, you don't need cash. But that logic is backwards. Privacy isn't about hiding wrongdoing, it's about autonomy, it's about the freedom to live without every decision being monitored, analyzed, and judged. Cash is declining not because people hate it, but because convenience is a hell of a drug. We choose ease over privacy, speed over sovereignty. Every tap of a card, every swipe of a phone builds a profile. Data becomes currency, and you become the product. We were told this was modernization, that resistance was nostalgia. But what it really is monetary surveillance disguised as progress. So where does that leave us? Cash is dying, crypto is chaotic, volatile, and increasingly regulated. And CBDCs promise convenience while delivering control. The battle over the future of money isn't just about which technology wins, it's about which vision of society wins. Will money remain a tool for freedom, privacy, and individual autonomy? Or will it become a lever of control, a system where every transaction is monitored, every choice is tracked, and dissent can be punished not with arrest, but with financial exclusion? History offers clues, but no guarantees. Every form of money eventually falls when trust collapses. Rome's coins failed when debasement destroyed credibility. France's assignats failed when revolutionary excess met economic reality. The Confederate dollar failed when the government that issued it ceased to exist. Even gold, the supposed eternal store of value, lost its monetary role when governments found it too constraining. In 1971, President Nixon severed the dollar's link to gold, allowing the United States to print unlimited currency. It was called the Nixon shock, and it fundamentally changed the global economy. Money became pure fiat, backed not by precious metals, but by government decree and economic power. Since then, every currency in the world has been fiat, a social agreement that these pieces of paper or digital entries have value because we collectively agree they do. And for decades, that agreement held. But fiat systems come with a temptation that's proven irresistible: inflation. When governments can print money at will, they do. They fund wars, bail out banks, and stimulate economies by creating new currency. Each new dollar dilutes the value of existing ones, a hidden tax on everyone holding cash. Inflation isn't an accident or a policy failure. It's a feature, a way for governments to spend beyond their means while making citizens pay the price through eroded purchasing power. The 2008 financial crisis turbocharged this process. Central banks around the world engaged in quantitative easing, a polite term for creating trillions of dollars out of thin air to buy government bonds and stabilize markets. The policy saved the financial system from collapse, but it also inflated asset prices, enriching those who owned stocks and real estate while leaving wages stagnant. The COVID pandemic brought another wave of money printing, this time justified as emergency relief. Stimulus checks went out, businesses received loans, and central banks bought assets on an unprecedented scale. In the United States alone, the money supply increased by over 40% in just 2 years. The result was predictable. Inflation surged to levels not seen in decades. Prices for food, housing, energy, and everyday goods skyrocketed. Wages rose too, but not fast enough to keep pace. People felt poorer even as their paychecks grew because the money itself was worth less. And the official response was more of the same. Central banks raised interest rates to slow the economy, deliberately inducing pain to fight the inflation they had caused. It was a cycle as old as fiat currency itself. Create money to solve a crisis, inflate away the debt, and let ordinary people bear the burden. This is where crypto advocates saw their opening. Bitcoin's fixed supply meant it couldn't be inflated away. It was, they argued, digital gold, a hedge against the reckless policies of central banks. And for a while, the narrative gained traction. Institutional investors began buying Bitcoin. Corporations added it to their balance sheets. Countries like El Salvador even made it legal tender. The price soared, and suddenly crypto wasn't just for libertarians and technologists, it was mainstream, but mainstream attention brings regulation. Governments realized that uncontrolled digital currencies posed a threat not just to monetary policy, but to their power. Tax evasion, money laundering, and sanctions evasion all became easier with crypto. So they cracked down. Exchanges were forced to comply with banking regulations, transactions were monitored, and the anonymity that had been crypto's selling point eroded with every new law. The dream of decentralized money ran headfirst into the reality of centralized power, and yet the genie is out of the bottle. Blockchain technology exists, decentralized networks exist. Millions of people now hold assets that governments can't easily confiscate. The technology has proven that alternatives to state-controlled money are possible. The question is whether those alternatives can survive the coming regulatory assault and the rise of CBDCs designed specifically to compete with them. The future of money will likely be plural, not singular. Cash won't disappear entirely, but it will become marginalized, used primarily by those who distrust or can't access digital systems. Crypto will persist, but it will fragment into regulated versions for mainstream use and underground versions for those seeking privacy. And CBDCs will dominate, offering efficiency and convenience at the cost of autonomy and privacy. The world won't choose one form of money, it will use all three, each serving different needs and different values. But here's what matters most: understanding that money isn't neutral. It never has been. Every form of currency reflects the power structures of its time. Coins, centralized wealth and kings, paper empowered banks, and digital empowers whoever controls the code. That means the battle over the future of money is really a battle over the future of freedom. Will we live in a world where financial transactions are private, where you can save, spend, and trade without asking permission? Or will we live in a world where every transaction is monitored, where algorithms decide who gets access to capital, and where dissent can be punished with the click of a button? The answer depends on awareness. Most people don't think about money this way. They think about paychecks, bills, and purchases. They don't think about the infrastructure underneath, the central banks, the payment networks, the surveillance systems. And that ignorance is dangerous because it allows the transformation to happen quietly, one convenience at a time. By the time people realize what they've lost, the system will be entrenched and opting out will be nearly impossible. So what can you do? First, diversify. Don't keep all your wealth in one form. Hold some cash for emergencies. Explore crypto if you're willing to learn the risks. Consider assets like gold or real estate that can't be easily monitored or confiscated. The goal isn't to pick the winning form of money, because there won't be just one winner. The goal is resilience, the ability to function no matter which way the system shifts. Second, educate yourself. Understand how money actually works, not just how to use it. Learn what inflation is and how it erodes wealth. Learn how central banks manipulate interest rates and money supply. Learn how blockchain technology functions and what makes crypto different from traditional currencies. Financial literacy isn't just about budgeting or investing, it's about understanding power. The more you know, the harder you are to manipulate. Third, demand accountability. Governments and corporations will push for digital systems that benefit them. They'll frame it as progress, efficiency, and security. But progress for whom? Efficient for whom? Secure for whom? Ask those questions loudly. Demand privacy protections. Demand transparency about how data is used. Demand limits on surveillance. The future isn't inevitable, it's being built right now, and public pressure can still shape it. History shows us that money evolves, but the principles remain constant. Trust matters more than technology. Power concentrates around whoever controls the supply. And the most dangerous position is blind faith in any system, no matter how stable it seems. Cash seemed eternal until it didn't. Gold seemed unshakable until governments abandoned it. Fiat seemed invincible until inflation reminded everyone it's just paper. And digital will seem permanent until the day it isn't. The lesson isn't pessimism, it's realism. Every form of money works until it doesn't. Every promise holds until it breaks. And the survivors aren't the ones who trusted most, but the ones who understood what money really is, a story we agree to believe. When that story changes, and it always does, the question is whether you'll be ready. So ask yourself, when the next chapter of monetary history is written, will you be someone who saw it coming, or someone who woke up too late? Will you hold assets that survive the transition, or promises that evaporate when trust breaks? Will you understand the system well, enough to navigate it, or will you be navigated by it? Cash, coins, or code? The answer isn't one or the other, it's all of them and none of them. Because money isn't about the medium, it's about the trust, the power, and the freedom embedded in every transaction. And right now, that freedom is being rewritten in code for better or worse. If this gave you a new perspective, hit subscribe. History doesn't repeat, but the patterns never stop. And the next revolution has already begun.